I'm Shay Russell from mining.com.au. And speaking with me today is Warwick Grigor, the Executive Chairman for Aguia Resources. Warwick, it's great to see you again. How are you?
Very well, thank you, Shay.
When we spoke recently, we were discussing gold, and we're going to take a little bit of a different tangent today and talk about another one of Aguia Resources' projects, and that is phosphate. Now, phosphate is a critical nutrient source. So could you please tell me a little bit about Aguia's project and, what makes this one interesting for you?
Well, this is a very, very important project for Brazil because it's an import replacement project. Basically, almost all of Brazil's phosphate comes from Morocco. It's high grade, 30% plus, expensive to transport. It's fine, but if you can get phosphate, get the logistics right, so you don't have to put it on ships and trains and travel thousands of kilometres. We've got an amazing strategic advantage in logistics. All of our product can be sold within 300 kilometres of the mine, and that makes us very competitive, especially if you're competing with something that comes all the way from Morocco. There's about a $70 a tonne shipping advantage that we have. So once we get into production, it's not going to be hard to sell it.
We're going to touch on the economic advantage this project has just shortly. You mentioned that it doesn't have the same higher grade as Morocco, but in this case, that doesn't matter, does it?
Not really. Having the best grade, it's not necessarily the best product for that community, for that part of the world. We've got rock phosphate. We add no chemicals to it, no pollutants to it. It's very environmentally compatible with the soils and the environment. It's only about a third of the grade of the Moroccan material, but you adjust the price, you get a lower price, but we also have trace elements that your phosphate from Morocco doesn't have. And we announced just yesterday tests to show how it performs with the local soils and the crops. And it just confirms yet again that we've got a very marketable product at a price that's not excessive. It'll be very good for the local community.
And finally, you have noted before that there are favourable economics here supporting this project. What are they, and how does that give you an edge?
We only have to truck the product within 300 kilometres of the mine site. We don't have to transport thousands of kilometres with enormous logistical costs. That's probably the main thing. The grade is good enough to make a serious difference. It actually performs better than the Moroccan material for the given grade. What we've got also, which is very important, is we're entrenched in the local community. We're not just a foreign company that's going up and setting in a paddock a new operation, a brand new operation, and then we've got to make friends with the locals and all those, get the social license organised. What we're doing, rather than build a brand new plant that might cost 35 million, we are leasing a facility from an existing industrial complex whereby we only have to spend 5 million in capital to achieve the same capacity that we would have with a brand new $35 million facility. Now, being part of the local community, we've got immediate acceptance. In fact, the company that we're dealing with on a 20-year lease on the plant, they actually want to market our product. They've got the sales force already. We have to pay 5% commission, but that's pretty fair. The other thing is, because we're occupying 10% of their industrial space, we've got a lot of technical support, whether it be engineers, fitters and turners, mechanics, whatever. We're part of a community, and that's very important to get that social acceptance.
It certainly is, and it can often be a key ingredient to making sure these projects not just get off the ground, but thrive. Listen, Warwick, I want to thank you so much for taking the time to talk with me about this project, and I look forward to future updates.
Thank you, Shay.